With over 5,700 crore rupees as assets under management, our fund under the scanner this week is one of India's biggest equity funds. Launched in October 1995, this large and mid-cap fund was on top of the performers list in its category until 2007. But it hasn't managed to impress its investors since the slowdown of 2008. The fund managed to contain its losses in 2008 by holding a large portion of its assets in cash, and as a result, it was caught on the wrong foot when the market turned around and failed to meet its benchmark for the returns that year. In the 3 years that followed, its mediocre performance caused the fund to slip into the bottom quartile of its category. The fund's huge asset base may limit it from adopting an aggressive mid-cap strategy, and it may not be able to mimic its earlier performance. The fund is now banking heavily on financials, healthcare and technology. Let's take a look at some numbers. If you invested 1,000 rupees in this fund when it launched 16 years ago, you would have 39,324 rupees today. So should this fund be a part of your portfolio? Our experts are here to give you the answer.
Thanks, Savan. Well, Dhirendra, the Reliance Growth Fund has had returns that have largely been in line with the benchmark and the category average. But its assets under management have grown to nearly 6,000 crore rupees. Now, has that put pressure on fund management? Because we know that as the AUM grows, the fund management tends to become slightly more pressured to be able to be that nimble on making changes. Has that happened in this fund as well?
I think that has happened, and that apart, I think, the fund has lost its mojo. It has lost its charm. The fund, it was a very impressive fund through the bull phase. And we saw the whole turnaround in the market up in 2008, and ever since, it is struggling. It has not shown, and most of its bets, they fail to perform, or it's testing patience. I would say that, one has to wait for and 5 years into a market which has not gone anywhere. If you look at, 2008, then I think, this lot of investors are getting disappointed. It has not, on a relative basis, it does not provide enough variables for you to be, to stick to this fund.
Now, Reliance as a fund house tends to move a lot of its funds into cash when the market is low and volatile. Right now, this fund has 10% in cash. Now, will this strategy work? Because when the market does turn around, then the fund is caught on the wrong foot then with all of its money in cash.
No, I think that as a strategy, that's a very dangerous strategy. And if it works, you are unlikely to be complimented for that. Because if you go right by being in cash and escaping a market steep fall, I think most of such calls, they happen after something as, after a big fall, or you miss the big turnaround when it comes, as and when it comes. So we have seen that on occasion, the day on which the market went up by 15% 2 years back. Here is a fund which was, 35% into cash, and it was not the only fund. There were many such funds. In fact, 70% of our equity fund universe were caught on the wrong foot. Likewise, the strategy will be great if, this fund was heavily into cash before the market fell. We haven't seen such a situation. So I would say that strategy has not worked. I choose a fund manager to deliver me a great portfolio of stocks, not to time the market. And from that standpoint, it has not worked, and I'm not hopeful that it will work.
If you're not hopeful that it will work in the future, Dhirendra, for investors who've put in that 6,000 crore rupees into this fund right now, what would you recommend they do? Should they be pulling out their money, considering maybe another mid-cap fund?
I think so. There are superior alternatives available. This fund has not done well for a long period of time. In a bear phase, this fund does not know how to position or how to benefit from, or how to do better than others. There are superior alternatives. I would say, and good times, I don't know when it will be back. The good times are over about 5 years back for this fund.
Right, the good times are out for the Reliance Growth Fund. Dhirendra, finally, your rating of the Reliance Growth Fund, where would you place it?
I would call it a very average fund. I will give it a 3-star.
3 stars there for the Reliance Growth Fund on Investors Guide. We have time for one last question with Dhirendra Kumar. Paresh has written in. He's 30 years old and he works for an IT company. Now, he has a home loan of 22 lakh rupees and he pays an EMI of 19,000 on it. Now, he wants to know, if there is a mutual fund that will help him pay off his home loan faster. He can invest 15,000 rupees per month in a mutual fund right now, and he wants to repay his loan in the next 5 years. Dhirendra, does that make sense as a strategy for a retail investor to use equity at this point to beat the interest he's paying on his home loan?
Yeah, if he's thinking of, 5-7 years ahead, then maybe, this may not be a bad strategy.
So what would you say he can hope to expect from his equity investment if he were to invest in a mutual fund today? And given where the interest rates are right now, what can he expect from an equity investment over the next 5 or 7 years?
My basic expectation from equity, given that, I'll be assuming the market risk, will be at least 1.5 times from, what the prevailing fixed income rate is. And given the state of equity today, I don't think it's it's an unreasonable expectation. Of course, what we have got, the long-term return from equity in India, what we have got over the past 10-15 years, that may not be replicable. That we may not get that in future, given the larger base of the market. But I don't think, expecting 1.5% is an unreasonable return given the current valuation.
If you were going to put some money in a mutual fund to beat that home loan rate, which mutual fund would you recommend for the next 5 or 7 years?
Assuming that he is carrying his home loan till its maturity, and he is, and independent of that, he is carrying an investment portfolio, then I would suggest him to go for an aggressive plan. But thinking that he is planning to liquidate his investment over the next 5 years from his accumulation through investment, then I would say that a stable growth portfolio will be a better bet with given that time frame, 5 years.
All right, Paresh, our stable growth portfolio is on your screen right now. It's a really simple portfolio with 4 balanced funds. Remember, Dhirendra said invest in these funds for the next 5 to 7 years, and you should be able to beat that rate on your home loan right now. Dhirendra, thank you so much for spending time with us and joining us on Investor's Guide. Remember, if you have questions for Dhirendra, you can write to us on the email ID that's at the bottom of your screen.